Hello friends, welcome back to Investment Professor, where real investing meets real results. I'm AK, and in this video I'm going to show you an incredibly effective trading strategy that I just have to share. Disclaimer: the information presented in this video is for educational and entertainment purpose only and is not a financial advice. I am not a financial advisor. Trading can result in financial loss of funds. Please take this information and do your own research. It involves using two powerful technical indicators, Bollinger Bands and the RSI, Relative Strength Index. This strategy is simple, easy to implement, and has a high success rate if used correctly. So let's dive straight into it. Basics first. What is Bollinger Bands? Bollinger Bands are a popular technical analysis tool used to measure market volatility and to identify potential overbought or oversold conditions in an asset. Components of Bollinger Bands. Middle band, a simple moving average SMA typically set to a 20-day period. Upper band, plotted 2 standard deviations above the middle band. Lower band, plotted 2 standard deviations below the middle band. How Bollinger Bands work. Volatility measurement. When the bands are close together, narrow, it indicates low volatility. When the bands spread apart, wide, it signals high volatility. Price movements. If the price touches the upper band, the asset may be overbought. Price may decline. If the price touches the lower band, the asset may be oversold. Price may rise. Key concepts. Squeeze. This occurs when the bands contract, signaling a potential breakout. It suggests the market is consolidating and a period of high volatility may follow. Breakouts. When price moves outside the bands, it indicates a strong trend, but this doesn't necessarily mean a reversal. Breakouts are not trading signals on their own. Uses of Bollinger Bands. Trend following helps traders identify trends and potential trend reversals. Entry and exit points helps to time entry and exit points in trading based on overbought or oversold conditions. So let's dive straight into it. Setting up Bollinger Bands. The first step is setting up Bollinger Bands. If you're new to Bollinger Bands, you're in luck because this indicator is fantastic for identifying key support and resistance levels. It helps you see when a security is overbought or oversold, giving you potential entry and exit points. To set up the Bollinger Bands, go to TradingView or whatever charting platform you use, click the Indicators tab and search for Bollinger Bands. By default, the settings will be a 20-period moving average and a standard deviation of 2. However, for this strategy, we'll tweak them a bit. Here's what you need to do. Change the length to 30. This means the moving average will now calculate based on the last 30 candlesticks. Keep the standard deviation at 2, as this helps define the width of the bands. You can customize the appearance by changing the line colors or removing the background shading. This part is personal preference. What are Bollinger Bands? If you're unfamiliar with how Bollinger Bands work, let me explain. The middle line represents a moving average, which takes the average price over the specified number of candles, in this case, 30. The upper and lower bands are 2 standard deviations away from the moving average, forming a channel that prices typically stay within. When the price touches the upper band, it could indicate an overbought condition, and when it touches the lower band, it may signal an oversold condition. We'll use this in combination with the RSI to form our trading strategy. Step 2. Adding the RSI. Next, we're going to add the RSI, Relative Strength Index. This indicator tells you whether a security is overbought or oversold based on recent price changes. To add the RSI, go back to the Indicators tab and type in RSI. Select the top result. Now let's adjust the settings. Set the upper band to 70 and the lower band to 30. By default, the RSI length is set to 14, but for this strategy, we're going to change that to 13. If the RSI value is above 70, the asset is considered overbought. If it's below 30, it's considered oversold. These are key levels for spotting potential reversals. Step 3. Combining Bollinger Bands and RSI for the strategy. Now that both indicators are set up, let's combine them for some profitable trades. The strategy we're using is based on mean reversion. What's mean reversion? In simple terms, it means that after an extreme price movement, the price tends to return to its average or mean. For our strategy, if the price moves above the upper Bollinger Band, it's likely to revert downward. So we'd consider a short trade. If the price moves below the lower Bollinger Band, it's likely to bounce upward, so we'd consider a long trade. But here's the important part. You shouldn't rely on Bollinger Bands alone. You need the RSI to confirm the move. Step 4. The trade setup. For this strategy to work effectively, you can only enter a trade if both the Bollinger Bands and RSI align. For a long trade, wait until the price drops below the lower Bollinger Band and the RSI goes below 25. For a short trade, wait until the price rises above the upper Bollinger Band and the RSI goes above 75. This combination filters out many false signals and improves the accuracy of your trades. For example, if the price of a stock moves below the lower Bollinger Band, but the RSI isn't yet below 25, wait. Patience is key. Enter only when both conditions are met. Pro tip: watch for sideways markets. Here's a crucial tip to make this strategy profitable. Be cautious during sideways markets. When the price is moving in a narrow range, Bollinger Bands tend to tighten and the RSI remains stable. If you try to enter trades during these periods, you might end up catching a falling knife, which can lead to significant losses. A good rule of thumb: if the Bollinger Bands are narrow and the RSI is stuck between 30 and 70, stay out of the trade until the market shows clear momentum. Bonus strategy: divergence for extra accuracy. Here's a magical trick that can give you an edge: RSI divergence. Divergence occurs when the price makes a new low, but the RSI makes a higher low. This is a powerful signal that a reversal might happen soon. For instance, if the price moves below the lower Bollinger Band, but the RSI is making higher lows, it's a great sign that the market is about to reverse. This gives you a higher chance of a successful trade. Conclusion: that's how you can combine Bollinger Bands and the RSI to create a profitable trading strategy. This strategy works well in trending markets, but remember to avoid it in sideways markets. And as a final reminder, patience is key. Wait for both conditions to line up before entering any trades. When using this strategy, always remember, the trend is your friend. Whatever the reason, never trade against the trend. To do that, you must develop a strong trading mindset. This is where trading psychology becomes important. Check out my video on trading psychology for a basic understanding. If you found this video helpful, be sure to check out my other videos, like the one where I explain an 80% win rate strategy using MACD. You won't want to miss it. Thanks for sticking with me throughout this video. Now it's time to put what you have learned into action. Take notes, learn from it, and succeed. Let's grow together. Drop your questions or thoughts in the comments below. Thanks for watching, and I'll see you in the next video.